Thank you for coming to see me. I'm delighted to visit with you all. For those of you who have been watching my presentations here at this conference over the years, you will note that some years ago I began to move out of stocks that I used to deride as the penny dreadfuls, which is to say the very low market cap companies that were engaged in exploration, in favor of higher quality companies, often in favor of very high quality companies. And some of you will note, with pleasure or not, that I actually made fun of speculators. My wife used to point out that all the money that I now invest carefully, I made by being a wild-ass speculator, which is in fact true. So some of that criticism was disingenuous. What has happened is that very recently, the prices of the very small market cap companies have, I think, begin to come into focus, which is to say that the sector is no longer as unattractive as it once was. And better yet, if you finance these small companies, while for 12 years the financing terms favored the issuers, the financing terms are finally starting to favor the investors. What does that mean? Simply put, it means that the juniors in financings are having to include a wonderful instrument called a warrant. Issuer managers hate warrants, but they love options. An option and a warrant is the same thing. The difference is who gets them. If the management gets an option, the managers think it's good. If the investor gets a warrant, the manager thinks it's dilution. Interestingly, from a check writer's point of view, the relationship is exactly the opposite. After 12 years of being in warrant desert, I am suddenly in a warrant wonderland. Exploration is out of favor, and I'm returning to the sector. How does this occur? Well, in the first instance, you may have heard me say earlier today, I love hate. I love sectors that are out of favor. 3 years ago, when uranium was at $20 a pound, and most people equated uranium with Hiroshima and Nagasaki, I looked at it as a sector that was in favor. At $20 a pound, if the price didn't go to $60 a pound, if the industry couldn't reduce cost of capital, the lights were going to go off. I loved that. I used to make a joke that even an old, fat, bald, white guy like me could win the 100-meter dash if I'm the only guy that shows up to run. And the only way that you have that advantage in a race, if you're like me, is if nobody shows up to run. Nobody was in the uranium business. Looking back to 2021, when the oil price went sub-zero during COVID, amazingly, when the oil price had to go up, nobody was in the business. And when I wander around and talk to junior exploration companies today, they say, nobody will finance this. I say, here's a test. Can you spell warrant? It begins with a W. If you can spell warrant and continue to smile, you and I can continue to talk. And the intelligent managers now are saying to me, okay, Rick, I can pass this test. Now here's a test for you. Can you spell money, Rick? It begins with an M. That trade, money for opportunity and warrants, is a trade that's been absent for 12 years, and it's present today. Why would I care? What is the value of a warrant if the warrant is unlikely ever to be exercised? Well, the value to that is zero. But I would argue that the pricing in the sector suggests that on occasion, I will make an investment where the warrant actually does get exercised. And why is that? We've been in a 12-year bear market for exploration. Really, truly one for the record books. And by the way, the capital allocations made by the juniors prior to the 12 years were so stupid that one can suggest that in terms of exploration efficiency, we've been in a 20-year bear market. And 20-year bear markets are very, very, very good things for check writers. Beginning about 2 years ago, I started getting calls every week, literally every week, from major mining companies saying, Rick, we have to get back in the exploration business. Parenthetically, they sort of call downstairs to the exploration department, learn to their chagrin that they laid them off 10 years ago and they have nobody there. So they don't have the intellectual capital. I'm generalizing, some certainly do. They certainly don't have the project pipelines. The seniors and the intermediates have to move back into exploration. Their pipelines are empty. They're empty in terms of intellectual capital. They're empty in terms of project pipeline. It's a wonderful place. It's a wonderful place for the juniors. And better yet, from my point of view, the juniors can't raise money, which means they have to come to people who have money, which means that the terms and conditions for the first time in 12 years are favorable to check writers. What's wrong with the thesis? Let's talk about the risk. How am I doing for time? 13 minutes. I don't have enough time to talk about all the risks, but let's talk about some of them. How many issuers are in the room, by the way? That's not too bad. I might get out of here alive. Here's the big risk. Here's the big risk. And this will turn a lot of you off, but I love this one. If you took every junior exploration company in the world, Australia, AIM, those few in the US OTC, the TSXV, everyone in the world, let's say there's 2,500 of them. I actually don't know how many of them there are. Let's say 2,500 among friends. And you merged all of them into one company. We'll call it Junior Explorco. Because we're in Canada, we'll call it Junior Explorco Limited, okay? Junior Explorco Limited, in a very good year, in a banner year, would lose $2 billion. In a bad year, it would lose $10 billion. Now, perversely, the juniors regard the bad years as good years because they could raise $10 billion to lose it. And they consider the good years to be bad years because they can only lose $2 billion. Suffice it to say, the industry as a whole loses somewhere between $2 billion and $10 billion a year. What should it trade for, this industry? Should it trade for 6 times losses? Should it trade for 9 times losses? As recently as 2010, it traded at 15 times losses. That's a pretty good price-loss ratio. That's a risk. The backside of the risk is this. In a sector where the expectation is failure, and by the way, the expectation is one that they've delivered on year after year after year, incredible value destruction, mind-boggling value destruction. I mean, these guys make governments seem efficient. A small subset of these companies generates so much performance that they add legitimacy and sometimes even luster to a sector that loses between $2 and $10 billion a year. If you think about the heavy lifting that is achieved by the few good people amongst the lame, the halt, and the blind, what you recognize is that the achievement of the overachievers is magnificent, not merely in the context of mining, but rather in the context of capitalism as a whole. Imagine a Robert Friedland, imagine a Lucas Lundin, imagine a Ross Beatty, imagine the job that these people have done in an industry that loses between $2 and $10 billion a year. Imagine, too, being dumb enough, which I'm about to be, to speculate in this sector. The reason that I'm willing to do it is a subset of serially successful people that generate year after year positive returns in a sector that loses literally billions of dollars. Better yet, imagine a market that's so deeply out of favor that you can buy the best people in the market at a very small discount to the price that you would pay for the lame, the halt, and the blind. The industry is held in such low regard that people who are serially successful are priced as though they were as dumb as most of the people in the industry. It literally, truly does not get better than this for a speculator who has the ability to differentiate among management teams. I gave a speech here many years ago. I'm going to say it was in the year 2000. And I said that there was nobody in Vancouver who was cognizant and who had $50,000, there was no way, no reason that those people, if they applied themselves through the decade of 2000 to 2010, couldn't come out of here a millionaire. The reason for that is that you are in the epicenter of exploration finance worldwide. When I say that there's a very small group of performers in a huge universe of pretenders, your job as a speculator is to know the difference between the performers and the pretenders. Being here in Vancouver, you can do that. You can go to these offices, you can talk to people, you can determine who has been serially successful. Many people in the audience say, well, Rick, you're Rick. I guess I am. That means you can talk to these guys. They'll talk to you. They'll talk to you too. The serially successful people are so unbelievably engaged in what they do that they don't want to talk politics. They don't want to talk about baseball. They don't want to talk about popular culture. They want to talk about what it is they're doing. And the easiest way that you can segregate between a producer and a poser is simply whether or not they will engage with you. Ross Beatty was here this morning. When Ross Beatty walked off stage, he was mobbed by people. He didn't run away. He stood and talked. A local exploration billionaire wanted to talk to you. The guy who doesn't want to talk to you, the guy that wants to run off stage and go get himself a Starbucks, or wants to run away for a 3-cocktail lunch or something like that, that's not the kind of guy that you want to talk to. So let's talk about, hopefully I've scared away those of you who don't want to do the work for the exploration sector, and I hope I've whetted the appetite of those of you who do want to do the work. Let's talk about the 3 important variables. Let's talk something about how. The first is people. Really, truly, it's people. Think of front-end exploration companies as research and development companies. Think about the process of exploration as being very similar to the process of biotechnological innovation or software innovation. What you're talking about doing is you're talking about commercializing a conceptual target. You're talking about answering a series of unanswered questions. People regard it as an asset-intensive business, but the truth is, in the exploration business, almost all of your assets are excuses to spend money which will not yield results, which means really that these exploration assets, if they were understood correctly, are liabilities, not assets. The assets are the intellectual capital of the people that are developing the thesis by which they propose to test the asset. Does everybody follow what I'm saying right now? It's very important that you get this. You make money in speculation by answering a series of unanswered questions, increasing the investment community's knowledge and certainty with regards to the viability of your asset. It doesn't occur in small periods of time. It occurs in large periods of time. And you don't get just one yes answer. You got to get a yes answer, which supposes another problem. Then you got to get another yes answer. Then you got to get another yes answer. Then you got to get another yes answer. As speculators, your job is to understand the unanswered question. Understand how the question was posed, whether or not the question was posed because it was convenient or because it mattered. In 40 years of asking exploration companies what their most important unanswered question was, fully 80% of the time, the managers would say to me, I never thought about it in that context. That's a really good answer. It means I never have to talk to that person again. I get to throw it away and concentrate my efforts on good companies. It's as though they were preparing to walk from Vancouver to Whistler, and they headed due east. If you don't have a plan, you ain't gonna get there. So it's important for you, if you're going to invest, if you're going to speculate in exploration, that you understand that the whole process is answering a series of unanswered questions. And the most important presupposition in the process is the people. The people propose good questions. The people test the thesis well. The people, because of prior successes, attract good employees. The people have a lower cost of capital. The people attract better people to work for them. So the presupposition of all this is good people. How many people here are familiar with Pareto's Law? Raise your hands. Let's do it the other way. How many people aren't familiar with Pareto's Law? Okay, so let's do Pareto's Law. Pareto's Law is about people. Pareto's law suggests that in any given task in society, 20% of the producers generate 80% of the utility. By the way, it's a bell-shaped curve, so a different 20% of the people generate 80% of the aggravation. Your first job is to align yourself with the good 20 and avoid the bad 20, like the plague. You live here in Vancouver. You see them all. You see the bad guys at the bar. You see the good guys working, right? I mean, the cool thing about Pareto's law, or one of the cool things about Pareto's law, is you take either the good 20 or the bad 20, you run them through the same performance dispersal curve, and they conformably align. In English, that means that 20% of the 20% do 80% of the 80%, or 4% of the people generate something like 65% of the positive utility. What I've learned now for 50 years in this racket is that performance dispersal curve conformably aligns at least one more time, which means that 8/10 of the population, or 1% maybe to be easy, generates 40% of the positive utility. What that means is that if you just hang out with the serially successful and don't do anything else, you will make more money than anybody else on the block. I have never myself been disciplined and patient enough to follow that very good advice. But the point is, in exploration, that you have to hang out with the serially successful group. It's important, too, that expertise be directly related to the task at hand. Let me explain. Someone comes to me and says, well, Rick, you need to invest in me because I've been successful in mining. Wonderful. How so? I successfully operated a gold mine in Archean, 2 billion-year-old terrain in French-speaking Quebec. Oh, yes. And what is it that you're doing now? I'm exploring, notice not operating, for copper gold in 15 million-year-old tertiary volcanics in Spanish-speaking Peru. The success in the first instance doesn't equate to expertise at the task at hand. Are you with me in this? It's very, very important that the expertise demonstrated be reflected in the task at hand. So people will say to me, but Rick, you invested with Lucas Lundin, who had no specific expertise. Yes, he did. His expertise was hiring experts. And he was really, really, really good at it. His other expertise was telling the truth. An unusual attribute in the mining business. So he was able to attract capital. So it's important that you understand the expertise in terms of the task at hand. If you're exploring, if you're engaged in the exploration business, and you're exploring in central Peru, in the Peruvian highlands, you want the exploration team to have experience in tertiary volcanics. It would be nice if they spoke Spanish, so they could talk to the local employees. It's important that they have expertise to the task at hand. I don't have much more time to chastise you, so I'm going to talk a little bit about the type of exploration companies I'm looking for. And I'm looking for three types. The first is I love the prospect generators. I love the people who use their technical and investment acumen to generate conceptual ideas which they then sell to other people. I'm an opium addict, opium being other people's money. The idea that you generate projects and the heavy lifting is done by other people gives me two advantages. One, leverage on their money, but two, access to their expertise. The people farming in do some of my due diligence for me. If Teck is going to spend $20 million on a project, I know that the intellectual capital within Teck has done better due diligence on that project than I can. So I love the prospect generators. The market hates them because they never have to go raise money. So the brokers hate them. There's no fees. Because there's no fees, there's no research. Nothing I like better than a wonderful sector that nobody else cares about. In a market like this, the other thing I like is discovery holes. The third dimension goes into a project. Somebody has a drill hole, a truth machine. Very often now, after a successful result, the share price goes down. Doesn't get any better than that. You have the ability to review results in the cold light of day with no competition around because people don't want to be in the exploration business. The third thing I like now is world-class deposits. I define a world-class deposit as sort of $10 billion in situ recoverable reserves and resources at today's commodity prices, where there's uncertainty as to metallurgy, consistency, something like that. The Centaurus of the world, the Sovereigns of the world, names like that. The idea that I can get the benefit of $400 million sunk expenditure, where I think the deposit is probably worth $1.5 billion, and the market cap is $200 million, is just, how do I say it? At 70 at least, the most fun one can have with one clothes on. This is just a superb set of circumstances. How to do this? Well, for most of my life, I've wanted to be involved in private placement, so I got a warrant where I doubled my upside with no increase in my downside. Today, I don't necessarily need to do that. There's lots of on-market opportunities in exploration. But for the purposes of this audience, I don't want to talk about the last category. I don't want to talk about the $200 million advanced exploration plays. I want to talk about the front end. I want to talk about the sub-$10 million market cap. This is as unloved an asset class as I have ever seen in my life, which means perversely I love it. You are not going to be able to get immediate gratification. You're going to buy one of these penny dreadfuls for 20 cents, and you're going to be rewarded for your intelligence by seeing it fall to 15. That's what's going to happen. And you have to have the courage of your convictions in a way that will allow you to handle the volatility, to handle the lack of intellectual affirmation that comes from a increasing share price. But if you do it, at least if your history is as lucky as mine has been, you'll be rewarded. I need to say, for those of you who are present, that statistically, almost all exploration efforts end in failure. So don't do this if you aren't willing to accept a lot of 25% losses, looking for 1,500% gains. But the simple arithmetic is one 15-bagger with a full warrant, which becomes a 25-bagger, amortizes a shitload of 25% losses. That's the way it works. Buffett once said, you shouldn't buy a share of a company if you wouldn't be delighted to see it fall 30% the month after you bought it, so that you could apply the same intellectual capital and buy more stock. Now, sadly, I've tested that thesis dozens of times in my career, but it ends up being very true. At any rate, ladies and gentlemen, I hope that I have reintroduced a topic to you that used to be a wonderful subject of discussion in Vancouver, and a topic, too, that will make people, hopefully myself included, literally hundreds of millions of dollars here in Vancouver over the next 5 years. I'm delighted to be re-embarking on this journey, and I hope some of you have the courage and the determination to join me. Thank you all.